Hit me up directly if you need help managing particular trades. I'm available online all day, every day, streaming and answering questions live. So tomorrow morning is going to be a panic open. Last week, I led with the word potential because the week was packed with earnings and a whole bunch of other catalysts. So we did have potential. The only problem is we dug ourselves a hole to begin with, and we spent the week recovering. It was an extremely exciting week. Speaking of exciting, hold that thought. This is what's going on right now, and we gapped down. We're looking at almost a 2% drop. This is the NASDAQ. Well, it's fallen into the drop from the 26. Whatever happened last week, forget about it. On the S&P, we're even a little bit lower. We did pierce the low from the 27th. This here is normal price action unfolding in an abnormal way. I don't disagree. The ticks are created by headlines, but the price path needed to happen anyway. We were looking for dips. This one just bigger because they are reluctant at giving us red days. And when you hold out for red days, then they come all bunched up together. I had planned to go through these with you, which is one ETF after another, sector by sector. We are testing supports from quite a few days ago. There was extreme strength in the XLF, the financials, upper right left-hand corner, and the XLV. So those two are my focus going forward. I am short the XLF financials on multiple levels. This dip makes all of my trades green, and I've shared a few of them. For example, JP Morgan, bear call spread, this dip brings it back to life. So there's nothing new going on here. We're just testing levels that we need to test every once in a while. Hopefully, the powers that be out there will come to their senses. If we got triggered red ticks from headlines, we will be triggering green ticks from headlines. I would imagine at some point in the next few weeks, somebody will say, sources to the matter suggest that they are close to a deal on tariffs, and then the market will rally again. I think the information that we need to trade is inside the charts and the fundamentals. Speaking of fundamentals, we have more earnings. We still have quite a few exciting names. Alphabet, of course. Qualcomm is important, and Amazon and ARM. I'm going to lock some profits and see if I can maybe go along a few tickers that I deem inside of a support zone. My take on the market is that we are extremely overbought. From the traditional sense, the S&P is twice the valuation it typically is. That cannot usually last without a correction. We haven't even started falling. So we are down to, if we drop another 2.5, we could trigger another leg lower, but it'll be like a lower high, lower low trend. This is where we stand. Show me where's the bearish scenario. And this red W on my screen, to make it into layman's terms, would suggest we can fall a total of 7% and still be, quote, normal. I'm just bringing to your attention how high we are. It's on a case-by-case basis for me. And the challenge is this time different? Here are 2 or 3 drops, almost too close together. The fundamentals have not changed. Everybody had been alerted about tariffs coming with the new administration. They just now are seeing it in their face and they're panicking. The same scenario happened last August when the yen carry trade broke apart. Other than earnings next week, we have the jobs number on Friday, ADP. They give us the preview for the private sector on Wednesday. We have a slew of Fed heads talking throughout the week, but it's way, way too soon to start adding to current positions. It is okay to nibble, but no way am I going, oh my gosh, this is the buying opportunity of a lifetime, because they all have to trade inside this chart. So if this chart is going to fall, everything inside it is going to fall. So 111 might be a bargain for NVIDIA, but if the market drops 7%, NVIDIA is going to be a little bit cheaper, just as an example. If you've been reading my morning notes, you should probably be holding some VIX calls at a much lower rate than it is right now. So you can evaluate how much of that you need to keep. I don't like to trade my insurance. If you bought it for an insurance policy, I would keep it. If you bought it to trade, I would lock it in. There will be time enough to manage my risk. All I have to do is just wake up a little bit early and get ready. Make sure that I know where my risk is and I attack it one line at a time. I usually deal with the ones that are shortest time frame if it's options. If it's stocks, there's most likely no need to panic on anything. So exciting! Yes, it is. Painful to some. Opportunistic to most that have been listening to the message that we've been saying, a little bit more bearish than bullish. And please, please do not panic at the open. Join the live room. We're there all day, every day.